Hello everyone and welcome to the channel today. Originally, this was going to be a video about President Trump's best accomplishments and his greatest failures while being in office. However, when doing the research for this video, I realized that I would rather spend an entire video talking about just one singular topic. So instead, I will be talking about the Trump administration's tax cut, which was signed into law by President Trump on December 22, 2017. However, this did not have an effect on 2017's taxes, a misconception that a lot of people don't realize. Most of the changes introduced into the bill went into effect on January 1st, 2018. The bill was named the Tax Cuts and Jobs Act of 2017. This is a common talking point among conservatives and Republicans who are in favor of the president. According to the people on the right, these tax cuts help the middle class by sending them more money into their pocket, and increased incentives for businesses and large corporations to continue to invest and expand their companies. Democrats and liberals largely oppose this bill, as it seems as if the people who would receive the most benefits are the people who are in the top 1% of America. When this bill was voted on in the Senate, no Democrats voted in favor of this bill. When this bill was then passed to the House of Representatives, again, no Democrats voted yes on the bill. So after more than 2 years, exactly what good or bad have the Trump administration's tax cuts done for America? Let's find out. First, I want to read an excerpt from an article from the online news organization known as The Stream, a partial political news website aimed for evangelicals, Catholics, and Christians. In an opinion piece written by the name of Wayne Grudem, it's obvious to me that he is a conservative Trump supporter, but here is what he had to say. After 8 years of high unemployment and meager growth under President Obama's administration, the Trump tax cuts of 2017 and Trump's extensive canceling of excessive government regulations on businesses have given a tremendous boost to the American economy. An estimated 25,000 pages of regulations have been canceled, resulting in a savings of $3,100 per household per year. Another result of tax cuts combined with deregulation has been the addition of thousands of new jobs, so that unemployment before the coronavirus crisis fell to the lowest point in 50 years, and unemployment among African American and Hispanic workers was the lowest it has ever been in history. On Election Day 2016, which was in November 8th of 2016, the Dow Jones Industrial Average closed at 8,332.74. This afternoon, on August 28th, the year 2020, at 2:44 p.m., it stands at 28,618.39 points, which is an increase of 56% in 3.5 years, even including several months of the coronavirus epidemic. This is remarkable. So the purpose I had in wanting people to hear just the random opinion of someone who has lived in America these last couple of years is I want to give you what I would consider the average mindset of someone who believes everything that the president tells them and what they pay attention to on the mainstream media. And very quickly before we move on, I want to point out two glaring issues that I have in Wayne's post, who I would identify as the average American. To address these points, I'm going to be quoting from an article by the Pew Research Center. In the article, it states this: data from 2016, the latest available, provides key insights into the broad reach of stock market investment in the United States. While a relatively small share of American families, 14%, are directly invested in individual stocks, a majority, 52%, have some level of investment in the market. Most of this comes in the form of retirement accounts such as 401ks. Participation in the stock market varies considerably across demographic groups, but even among those with annual family incomes of less than $35,000, about 1 in 5 have assets in the stock market. The shares increase as income rises, and among those with incomes above $100,000, 88% own stocks either directly or indirectly. Families headed by white adults are more likely than those headed by black or Hispanic adults to be invested in the stock market. A majority, 61% of non-Hispanic white households own some stock, compared with 31% of non-Hispanic black and 28% of Hispanic households. As you just heard from what I told you, slightly over more than 50% of Americans hold any money at all in the stock market, and disproportionately more white American family households own a stake in the stock market than when compared to black and Hispanic Americans. This next excerpt is from the online news site The Irrelevant Investor, and here is what they have to add to the issue. Have you ever wondered who actually owns the stock market? Now we know thanks to a new piece from the Urban Brookings Tax Policy Center. And quickly, Just to clarify, the Brookings Tax Policy Center is a bipartisan, non-biased organization that analyzes tax policy. Now back to the article. Two things jump out at me from this chart. First, at 40% of the US stock market, foreigners own more than taxable accounts, 25%, and retirement accounts, 30%. As you probably know by now, people with money own the bulk of the stock market. The next chart shows this quite clearly. The top 10% of households on average own $1.7 million of stock, directly and indirectly, while the bottom 50% hold just $11,000 on average. With this new information in mind, this helps us gain a clearer picture on who is investing in the stock market and who owns the most. Like I mentioned previously, barely more than 50% of all Americans have a stake in the stock market. Out of the 100% of people who are invested in the stock market, the top 10% of stockholders on average own $1.7 million of stock, while the bottom 50% holds just $11,000 on average. Overall, whenever you hear someone using the stock market as a measure of how well the average American families are doing, in my opinion, it is a load of BS. In my opinion, we should not be using the stock market as an indicator as to how the average American family is doing. Yes, in a good economy, the stock market can be performing well, but who is it performing well for? If you're invested in the stock market, that's great for you. But it's like the old saying says, you have to have money to make money. Now, let's return our focus on Trump's tax cuts. Quoting from an NPR article talking about the tax cuts, here is what they had to say on the matter. This was posted on December 20th, 2019. Here is what they had to say. More than 60% of the tax savings went to the people in the top 20% of the income ladder, according to the Nonpartisan Tax Policy Center. The measure also slashed the corporate tax rate by 40%. Boosters of the tax cut insisted the economy would grow so fast it would more than make up the revenue lost to lower rates. The tax plan will pay for itself with economic growth, Treasury Secretary Steve Mnuchin said. It has not worked out that way. It was unbelievable at the time, and it's proven to be absolutely untrue, said Maya McGinnis, president of the Committee for a Responsible Federal Budget. The tax cuts were never going to, and have not, come anywhere close to paying for themselves. I would like to remind everyone that Maya McGinnis did not state whether or not the tax cuts proved to be more beneficial than harmful, especially to the average American family. But she is definitely critical of the policy. She represents the Committee for a Responsible Federal Budget, which is an independent, nonprofit, bipartisan public policy organization based in Washington, D.C. that addresses federal budget and fiscal issues. Now back to the article. Corporate tax revenues fell 31% in the first year after the cut was passed. Overall tax revenues have declined as a share of the economy in each of the 2 years since the tax cut took effect. Not surprising, if you cut taxes, you get less in revenues, McGinnis said. And what we've been doing at the same time is we've been increasing spending, and no surprise, our deficit has exploded. The federal deficit this year was $984 billion, an extraordinary figure at a time when the country is not mired in recession or widespread war. The tax cut also failed to produce a permanent boost in economic growth, despite promises from Republican supporters. After 8 straight years of slow growth and underperformance, America is ready to take off, Senate Majority Leader Mitch McConnell said when the tax cut passed 2 years ago. In fact, the economy grew 2.9% last year, exactly the same as in 2015. There was an acceleration in terms of momentum for business investment, but it was rather short-lived, said Gregory Dacko of Oxford Economics. A year further down the road, we're really not seeing much of any leftover of this fiscal stimulus package. To be sure, the stock market is booming, and unemployment is near record lows. But while most Americans give the economy high marks, that doesn't extend to the tax cut. A Gallup poll last tax season found only about 40% of Americans approved of the cut, while 49% disapproved. Even though experts say most workers did get a bump in their take-home pay, it was largely invisible to many taxpayers. Only about 14% of those surveyed by Gallup believed their taxes went down. That figure includes 22% of Republicans, 12% of Democrats, and 10% of independents. So not only did the effect of the Trump administration's tax policy not have a large noticeable effect on the average working American, the tax policy also increased our country's debt deficit by $984 billion. So does that mean it was all bad? Not necessarily. Now I will quote an excerpt from a post from the online media site MarketWatch, which is a slightly right-leaning news website but largely unbiased. Here is what they had to say when their article was posted on March 4th of 2020 this year. Americans paid almost $64 billion less in federal income taxes during the first year, under the Republican tax overhaul signed into law in late 2017 by President Donald Trump, with some of the sharpest drops clustered among taxpayers earning between $25,000 and $100,000 a year, even as the overall number of refunds dropped during a turbulent tax season. Americans had $1.552 trillion in tax liabilities last year, compared with $1.619 trillion in total tax liabilities at the same point a year prior. Just in case you don't know, a tax liability is essentially all the money that is owed in taxes. That's a drop of 4% on a year-over-year basis. Taxpayers making between $40,000 and $50,000 a year had the largest fall in average tax liability, a 14.5% drop, while high-end households making between $250,000 and $500,000 had the second largest decrease, with a 14.4% liability reduction. Taxpayers making at least $1 million had a 4.3% decrease in average tax liability. The overhaul may have been lightened tax burdens in the big picture, but that doesn't mean it was a smooth ride for everyone. The IRS issued almost 2 million fewer refunds on a year-over-year basis, amounting to almost $360 million less in refunds. Almost 890,000 more returns show taxes owed under the first year of the Trump tax cuts, the data show. The data, according to Treasury Secretary Steven Mnuchin, show the tax cuts were effective. Adjusted gross incomes were 5.7% higher in the November 2019 statistics than a year earlier, he emphasized. President Trump's pro-growth economic policies, including the Tax Cuts and Jobs Act, are working to increase wages and lower the tax burden for hardworking Americans, Mnuchin said in a Monday statement. Mark Mazur, director of the Urban Brookings Tax Policy Center, said the tax cut picture is more nuanced, with more of a mixed record so far. The revised tax code is not as tilted towards billionaires as some of the rhetoric may lead you to think. But it is the case the Tax Cuts and Jobs Act favored higher income people, he told MarketWatch. Mazur said the law cut taxes for a lot of households, but added that it only provided a boost for the economy in the short run, without strong wage increases or huge bursts in investment in the U.S. from corporations. Focusing on personal taxes didn't tell the whole story, according to Steve Wamhoff, Director of Federal Tax Policy at the Progressive Institute on Taxation and Economic Policy, or ITEP. The parts of the Trump tax cuts that really benefit the rich are not the personal income tax cuts, but the corporate income tax cuts and estate tax cuts, according to Wamhoff. Rule changes surrounding corporate taxes, which mainly benefit the mostly rich people who own corporate stocks, and the estate tax cuts are the parts of the law that made it a good deal for the rich, Wamhoff said. Among other noteworthy provisions, the tax cuts reduced the corporate income tax rate to 21% from 35%. It also raised the exemption before an estate tax kicked in, going from $5.4 million to $11.4 million. He added, "No one ever said that lower middle income people would get no benefits from the Trump tax law. What ITEP and others pointed out from the beginning was that the rich would get a disproportionate share of the benefits of the law, and nothing in this data conflicts with that." That was a very interesting article that sheds more light about how the Trump tax cuts affect everyone, not only rich people, but people from the middle income class as well. In an opinion piece article, again, published online by the MarketWatch, written by Howard Gold, this is what he highlighted in regards to the tax cut policy implemented by the Trump administration. Right before Congress passed the Tax Cuts and Jobs Act in December 2017, President Trump proclaimed, "It will be fantastic for the middle income people and for jobs, most of all. I think we could go to 4%, 5%, or even 6% GDP growth, ultimately. We are back. We are really going to start to rock." A year later, it's very clear that the tax cuts boosted gross domestic product and jobs a bit, and just for 1 year. Its effects are fading as US GDP growth appears likely to weaken in 2019. The only thing that rocked were corporate profits and the stock market, and we're facing trillion-dollar deficits as far as the eye can see. The Tax Cuts and Jobs Act made small cuts in rates to most individual taxpayers, while cutting the corporate tax rate from 35% to 21%, expanding deductions for pass-through companies, and taxing only corporate income earned in the US, not worldwide. That theoretically removed a major barrier to US-based multinational corporations repatriating the estimated $2.6 trillion in accumulated earnings they're holding overseas. The failure of the tax cut bill to achieve those intended results was made clear Monday when the National Association for Business Economics, the NABE, released its January Business Conditions Survey. This is a poll of more than 100 economists employed by major firms in corporate America. So they're hardly lefties, but they are guided by facts and hard data, not supply-side delusions. Some 84% of these economists reported that in the years since their passage, the tax cuts have not caused their firms to change hiring or investment plans. Actually, data show that firms did boost capital spending in the first half of last year, but that was fading by the third quarter. And an analysis by Daniel Alpert of Westwood Capital, reported by the Financial Times, showed that businesses put more than half of that into technology and intellectual capital, and only 28.6% in new structures and equipment. The opposite of 1998, a year when GDP grew by 4.5% and income was rising. So where is all that money going? Where else? Share buybacks, which hit a record $1.1 trillion in 2018. Companies actually spent more on buybacks than on capital investments in 2018's first half. And remember, CapEx weakened as the year went on. Buybacks shrink the number of shares, boosting earnings per share and eventually the stock price. That helps all shareholders, of course, but especially corporate executives, more than half of those whose total compensation is in the stock. And what happened to all the trillions of dollars the president promised corporations would bring back to the USA from overseas? That too has turned out to be a bust. The amount dropped 50% in the third quarter after starting out strong in the first half of 2018. See a pattern here? As economists projected, the tax cuts did boost GDP a bit. When 2018's final numbers are in, GDP probably will have grown 2.9% to 3%. That's a nice jump from 2.2% in 2017 and the anemic 1.5% in 2016, the year Trump was elected. But it will be virtually identical with the 2.9% GDP growth recorded in 2015, the highest of the Obama years. Since economists expect US GDP growth to slow to the mid 2% level this year, and some are even predicting a recession, that may turn out to be the peak of the Trump years too. Job growth has picked up, having risen by 2.6 million in 2018 versus a gain of 2.2 million in 2017. It's unclear how much of that can be attributed to the tax cut, since healthcare and professional and business services set the pace again, as they have for the past 30 years. As my Market Watch colleague Tim Mullaney pointed out, the gains in manufacturing, which the president promised would go through a revival, have been pretty modest. So, who gained? Well, corporate profits surged $78.2 billion in the third quarter, accelerating over the second quarter's $65 billion gain. Earnings from the companies in the S&P 500 index, SPX, probably topped $148 per share last year, about a 40% gain from the end of 2016. That's exactly what the S&P 500 gained from just before the election to its October 2018 all-time high. The numbers couldn't be clearer. Corporations, big shareholders, and top corporate executives reap the lion's share of the gains from the 2017 tax cut, which should be renamed the Shareholder and CEO Enrichment Act of 2017. It didn't boost economic growth that much, didn't start a capital spending boom or US manufacturing renaissance, didn't bring overseas profits back home, and might have led to modest job growth but little discernible wage increases, and will all be stuck with the bill for a long, long time. The final article that I want to draw your attention to was written by the online website Investopedia, where they did a complete analysis of Trump's tax policy and substantiated their claims with known information. Here is what is listed on their website. The changes are temporary, expiring after 2025, as is the case with most personal tax breaks included in the law. the expiration date allowed the Senate to comply with reconciliation rules that block a Democratic filibuster, which Republicans did not have the votes to defeat, only if the law does not raise the deficit in any year outside of a 10-year window and if it stays within its $1.5 trillion budget constraint during the 10-year window. As noted, Republican congressional leaders signaled that individual tax cuts could be extended at a later date. According to an analysis released by the Tax Policy Center on December 18, 2017, the law was expected to raise the after-tax income of 80.4% of households in 2018, but that cut was not distributed evenly or progressively. The analysis revealed that the tax break would hit 93.7% of taxpayers in the highest earning quintile, and only 53.9% of those in the lowest quintile. Even so, on average, every quintile was expected to receive a tax break. That is no longer expected to be true once individual tax cuts expire after 2025. At that point, the TPC estimates that the majority of taxpayers, 53.4%, will face a tax increase. 69.7% of those in the middle quintile, 40th to 60th percentile, will pay more, compared to just 8% of the highest earners at 0.1%. With the exception of that top 0.1%, higher earners will enjoy larger tax breaks as a proportion of their income. The Joint Committee on Taxation echoes this conclusion, estimating that the 22,000 households making $20,000 to $30,000 will collectively pay 26.6% more in 2027 than they would under the previous statute in that year. The 629 households making over $1 million will pay 1% less in its finalized form. However, the Tax Cuts and Jobs Act cuts the corporate tax rate, benefiting shareholders who tend to be higher earners. It only cuts individuals' taxes for a limited period of time. It scales back the alternative minimum tax and estate tax, as well as reducing the taxes levied on pass-through income, 70% of which goes to the highest earning 1%. It does not close the carried interest loophole, which benefits professional investors. It scraps the individual mandate, likely driving up premiums and making health insurance unaffordable for millions. These provisions taken together are likely to benefit high earners disproportionately and, particularly as a result of scrapping the individual mandate, hurt some working and middle-class taxpayers. The Pew Research Center reported in early April 2019 that there is a growing partisan divide over the perceived fairness of the tax system in America. An even greater proportion was troubled by the feeling that some corporations and some wealthy people pay too little. 82% said so about corporations, while 79% said so about the wealthy. While the new tax law cuts a number of itemized deductions, most of the loopholes and giveaways that were slated for repeal in earlier bills have been retained in some form. So all in all, what have we learned today? Well, about 65% of households paid less in federal income taxes under the Tax Cuts and Jobs Act of 2017 than they would have under old laws, with the highest earners receiving the biggest benefits, according to PolitiFact as estimated by the Institute Brookings Institution Tax Policy Center. Americans overall, from the wealthiest to the poorest taxpayers, paid cumulatively billions of dollars less in taxes overall. However, it is still important to note that depending who you are, and what your situation is, meaning whether you're married or what specific deductions or other programs you qualify for, your perception of the tax cuts will be vastly different than your neighbors. The undeniable truth of the matter is that the tax cut policy created and implemented by the Trump administration did not favor all Americans equally and favored the wealthiest Americans by more than just a slight margin, as some people on the right would like you to believe. I also mentioned earlier, by the year 2027, the middle and lower income class would have to pay more taxes than the wealthiest Americans. However, I find it interesting that the people on the right will claim that, oh, your taxes aren't going up until 2027. So by then, all we have to do is rewrite the tax code and then we can fix it to make sure that doesn't happen. Yes, while that's true, I still find it interesting that the Senate Republicans and House Republicans who were so in favor of this bill decided to take a prioritization over the wealthiest Americans, the top 10%, compared to everyone else in the lower brackets. The Trump administration's tax cuts did favor a majority of the average American working family. The best analogy that I can think of to describe the Trump administration tax cut policy is to think of it like this. The Trump administration's tax cut gave approximately 6 out of every 10 American families maybe $5 into each of their pockets, but gave $100 to the richest American family out of the 10. Do with that information what you will. Thank you for tuning into today's video. I appreciate your support and your time, and I hope you learned something new today. If you liked today's video, then please don't forget to hit that like button for me. It helps encourage me to make more videos just like this. If you want to stay tuned for more unbiased political content, then also subscribe to the channel. Thank you and have a good day.